Oh my God, it's so exciting to see you here. It's so exciting to see you here that I forgot how to use Zoom. Let me see. How do I change the view? There it is. Now I want to see all your faces. Hey, oh my God. This is so great. Oh, I didn't turn on my headphone.
We hear you.
For now. Yeah? Okay, now it's working. Now it's working. Now we're in business. Oh my gosh, so many good friends are here. This is awesome. I am so excited. How's everybody doing today? Feel free to put it in chat or unmute yourself, whatever you like. You good? I'm good. I'm
good.
excited.
Having a good day.
Hey, oh my God, I love how many friends are here. This is so doing good. So, oh, Heather, I'm so excited for this too. This is great. Well, I'm going to give a couple minutes for people to come in. And actually, while they're coming in, I have something so exciting to share with you. I am celebrating something really big today. Actually, technically, it was yesterday, but I was too busy to celebrate yesterday, so I decided I would celebrate with you guys. Yesterday was the 23rd anniversary of me starting my own bookkeeping business.
Wow.
I know, right? Woohoo! Cheers! By the way, it's before noon in Chicago, so this is actually pineapple coconut sparkling water. But I put it in a fancy glass because that means I'm celebrating. That's how you know. So cheers. And by the way, to anybody who has recently started their own bookkeeping business, I mean, it was in those early days, it was like totally an accident. It was like I was working for a company, like I was working internally as a senior accountant and hated my boss, and I was getting married and my mom was diagnosed with breast cancer. It was like a cray time. And I was like, I'm just going to leave this horrible job and temp for a while. And the first temp job I got ended up being my first client. So yeah, right? Like it doesn't have to be intentional for you to start your own business. It just happens. Oh, this is great. I am so excited. Yeah, feel free, Lori. You guys can have your videos on or off, whatever works for you. Oh, Nancy, the All-Star game. Was that something in Dallas? I'm guessing it was. Corey, I'm happy to see you. Oh, Sarah and Anisha and no, our house did not get hit by a tornado. So Teresa is asking in chat about that. Chicago had these horrible tornadoes, and we actually spent 2 evenings in a row sitting in. So we have a somewhat small like apartment, and the only safe place in here from a tornado is in our guest bathroom in the hallway. So Mark and our cat Lenore and I spent a couple evenings with our laptops. Well, Lenore doesn't have a laptop, but we do. And we just hung out there. And the toilet, for the record, is like not a really comfortable desk chair. I love that, Deb. Drinking out of fancy glasses while wearing fancy glasses. Yes. So awesome. Well, it is so great to see y'all. I want to make sure you feel completely comfortable coming and going. I won't take it personally. I know everybody's got really busy lives. We are recording this, and everyone who has signed up for the email list is going to get a copy of this. So if you have to go, you have to go. That's don't worry about it. So while people, it looks like people are still filtering in. We already celebrated my 23rd anniversary, but I'm going to do that one more time for anybody who didn't hear. Yesterday was the 23rd anniversary of starting my own bookkeeping firm. So cheers. My pineapple coconut water. So while people are filtering in, before we get to the Q&A, I want to share more exciting news with you that I know a lot of you already know about, which is that today is not only our Scaling New Heights Q&A. By the way, next year, I'm going to submit for a 100-minute session instead of a 50-minute session, so we can just do the Q&A like in the room. I think that would be so much easier. But hey, at least this way you get a recording of it, right? So bonus there. But today is also the soft launch of the subscription that I mentioned to you in the class, in the Tax-Ready Bookkeeper. It's called an Ask a CPA Q&A. I am not a salesy person, so I will keep this as short as possible, but I wanted to make sure that of all people, the folks who attended the Scaling New Heights talk get first dibs on this. My friend Ashley actually always says that she doesn't want to sell anything. She just wants to make something that people want and have them give her money for it. And that's kind of how I feel about this. So here's my sales pitch. I've noticed, as I'm sure y'all have too, that there's just this like giant freaking gaping hole where there should be a place to get real answers from tax preparers to your questions. I have searched the internet, and this is just like, I mean, you can do that in some groups on Facebook, but A, tax preparers tend to be jerks, even to each other. And B, how do you know that that information is correct? So like, and you can't, kind of by definition, my friend Dawn, who is on this call, she says by definition, if you have a question that's best suited for your client's CPA, they're probably the last person you can actually ask, because you're either, yeah, right? I'm getting a lot of nods. You're either questioning their ability, like, did they do this right? Or, right, you can't ask them that. Or you have a question that is a totally valid question, but it's going to undermine your credibility if you ask them. And which also is just the number of things about this that are stupid and annoying and crazy. Again, I started as a bookkeeper, so I know what it feels like to be talked down to and dismissed and made to feel like less than you are. So anyway, I get that that is a real thing. So I don't know why our industry is like this, but it's stupid and I want to fix it. So we built a low-cost membership, $47 a month, to try to fill this gap, but to try to make sure we grow it right. So like with the input of the people who most need it, we are initially just going to limit it to about 50 people. And 10 have already signed up. So we've got like 40 people, 40 slots left. And if you are interested in being a founding member, like in this first group of 50, you get a hella deal, which is 30% off your first 12 months. So that's $33 a month. My hubby is here and he is going to throw the details in chat, which he'll be posting a few more times throughout the Q&A, I mean, while people come and go. The coupon is Ask a CPA 30. Make sure you use the coupon code when you sign up so you get that 30% discount for the first year, because we super appreciate the folks who are helping us like shape the future of this membership. So it's going to include at first one Zoom Q&A a month, which will be at least an hour long. We're going to increase that to 2 a month once there's enough demand. It gives you a 25% discount on one-on-one consulting. Also lets you book in 40-minute increments, because normally I tell people like 2 hours is the shortest period of time, but y'all can do 40-minute increments. So it would be $100 for 40 minutes instead of a 2-hour block for $400. You get a private circle community, which is like a pain in the butt to set up. So I hope it works great. I'm in another circle community and it's really awesome, but it's also kind of buggy. It's become really popular, which is great, but hopefully that'll mean they fix things. Anyway, you can submit questions, participate in polls to upvote the ones that you're most excited to have answered. There are additional resources in there. You can connect with like-minded bookkeepers. You guys know the drill. There'll be a webinar. This is one of my favorite parts, once a quarter on a topic that's really specific to our community. So I have a whole list of things that people have suggested. So how to tie out the annual tax return to the books to make sure that it's right. Yeah, that's it. It's like they don't teach that. Freaking masters. Nobody teaches this. I don't understand why either. Doing like, let's say you get a new client and you want to do a journal entry for all of the previous years so that you have comparable financials when you're running an annual report. Like that's another one. Reasonable compensation. Tons of people ask about reasonable compensation. So that's a biggie that I want to do. A lot of people ask about accountable plans. Chart of accounts development by entity. That is something that I'm really excited to do, to like compare the tax return for each entity type to what like you should definitely make sure you have in the chart of accounts so that it matches up at least with those lines. So lots of other ideas. You can throw yours in as well. We're also going to have guest presenters and more. if you have ideas, I mean, like this, you guys, I am so making this up as I go along. If you have ideas about what you would want to see in a group like this, like let us know. You don't have to be a member first. You know what I mean? Like you can tell me, hey, here's what would make me pay $33 a month or 47 eventually. Here's what would make me pay that much per month. Here's what I want to see. And I'll be like, yeah, we can do that. Or no, you're crazy. Go away. I don't know. Okay. Enough of that. That's my sales pitch. More info in the chat if you want it, or you can always email askacpa@thedancingaccountant.com. Let's get into the good stuff. Actually, when I was reading all the questions that were submitted, I have like pages of them here. When I was reading these, my husband was teasing me because yes, I'm a nerd. Most of the people in here know me already. Of course, I'm a nerd. Guys, like I get excited about tax. Obviously, I'm a nerd. If you did not know that. And I was reading these, I was like, this is so much fun. I want all these people to be in my group because like I can't wait to answer these. There's such great questions. I love this. I'll reiterate for those who've come in recently, this is being recorded and everyone who's on our mailing list is going to get a copy. These questions. Okay, I've organized them into different themes. Like the webinars I was talking about earlier, these are like things that come up over and over and over again. And so I'm going to go through the list in that order. So we're going to try to address related questions like at the same time in the same section. But if you have more questions, please put them in the chat. And my beautiful assistant, Vanna White. Okay. Actually, it's my husband and his name is Mark, but he loves being called Markle Sparkle. So feel free to do that. He loves it when you do that. Call him out in chat, Markle Sparkle. Thank you, honey, for being here. I once actually sent him custom M&Ms at work, like back when he worked at a brick and mortar place that said Markle on half of them and Sparkle on the others. It was like he's an IT guy. He's a software developer. So it was like all dudes. And he got these huge packages of M&Ms said Markle Sparkle. Oh, that's great. He loves me. So anyway, feel free to do that. He's going to collect the questions. He's going to add them to my list in case we have extra time at the end. However, if you're clarifying something that I just said and you need to make sure, like if I said it wrong or you're not sure what I said, he's going to unmute himself. Like make sure to say that in the chat and he'll unmute himself and stop me. Because otherwise I'll just talk forever. I know Deb's on this call and she knows what I mean. We love to share everything we know with people. So, okay, what else? Moving forward in these Q&As in the subscription, we'll probably let folks like raise hands and ask out loud if you think that would be helpful. Also, if you have a question today and can't use the chat, like if you're in the car or something, like feel free to, as Misty Mejia always says, feel free to unmute yourself. And as I said, feel free to pop in and out as needed. I know you all have busy lives. I won't take it personally. This is being recorded. Okay, so let's get into the good stuff. Let's get into the questions. Anything before I start? We good? Yes. Oh, good. Good chat stuff. Okay, so the first section we're going to talk about are balance sheet accounts. I got a lot of questions, and it makes sense that I would have the most questions in this area because for those of you who are at the Scaling New Heights talk, the number one thing that you can do to like really up your game in terms of the quality of these financial statements and work papers that you're going to hand off to the taxpayer is proofing the balance sheet. So making sure that every single line is tied out to some source document and noting what that is. I just export the balance sheet to Excel and write a note on every single line. And the note can be as simple as like, see the bank rec, right? Like see the credit card. It can be really simple notes. But just knowing like, yes, I already did that. So it makes sense that this would be the most questions would be in this area. So Laura asks, what parts of the balance sheet should I focus on for tax filing purposes? I'm going to argue you shouldn't focus on any of them because it's essential that you have said something about all of them. And if you don't do anything else, remember the accounting equation works so that if your balance sheet is accurate, if every single line on that balance sheet is accurate, your P&L has to be correct. And that doesn't mean that it's going to be correct each line. I mean, you could have literally everything and ask my accountant, and but your bottom line on the P&L is going to be correct. And that's why proofing the balance sheet is so freaking important. So I would argue there is no part of the balance sheet to focus on for tax filing purposes. However, that said, y'all know what the easy ones are. Export the balance sheet to Excel, and on every single line where it's easy, just be like, see the bank rec, see the bank rec, see the bank, like see the loan amortization table, see the inventory list, the inventory count sheet, see the whatever. Most of these things like have something easy. Go through and do those first. Like make yourself, pat yourself on the back, and be like, oh my God, look how much I got done. And honestly, if you're doing those on a monthly basis, you're not going to have a ton left at year end when you're tying this out, right? So it's really a way to communicate with that tax preparer that they don't have to do these things and telling them where to find the information so that if they want to make sure you did your job. Here's the thing, the stuff that's left, that's kind of what you're going to end up focusing on because those are the hard ones. And I told the story in the class of we had a client with a tips payable account that just like kept going up and up and up, and we couldn't figure out why, because it seemed like people were getting paid out the right amounts. I think it was going negative. Actually, yeah, that's what was happening. It was going negative. It was weird. And I was like, obviously there's just something wrong. I mean, we're not paying out tips wrong, right? Obviously we're not paying out tips. Okay, so I put it off. To be fair, it was during the pandemic. I had a lot of other work to do. This seemed like the lowest of my priorities. It turned out that we had made a mistake in how the tips were being collected and paid out. And I had to pay the client back over $20,000. Right, so those are the ones you want to focus on, are the ones that you don't have an easy explanation for. Why is this going negative? Why is this not zeroing out when I feel like it should zero out? Like sales taxes never zeroes out the next month. Those are the ones you want to focus on, are like the weird stuff. So that's my answer there. Danielle asked, and this question is just like, ugh, makes my stomach hurt, but is probably the most common question I got. If a balance sheet needs a major cleanup in QBO, but the accountant doesn't rely on the QBO balance sheet and isn't concerned, what would you say to the accountant? I can't use bad language in this. It's being recorded. I don't want to reflect why, Deb, I see you. I'm like, I would say, because that is just BS. That is total BS. Really? Like, you're going to prepare a tax return and you're not even going to look at the balance sheet? It's the freaking accounting equation. If the balance sheet is right, your tax on the profit and loss, I mean, your income on the profit and loss, your net income is going to be correct. Why would you not? Why would you like not? No, I would not be okay with this. They go on to say, or would you insist on a balance sheet to match the CPAs, and why? Okay, I would insist. And I'm going to go back to this over and over and over again, because if that balance sheet is correct, then you know that the net income on the profit and loss is correct. That's why I would insist on a balance sheet. This is a great example. I mean, it was tagged as both balance sheet accounts in terms of themes and also tax preparer collaboration, because that is not cool, y'all. And I know it's common, but that indicates to me either a tax preparer who doesn't have enough experience, and this would be really good education for them, or a tax preparer that's not high quality and you do not want to be working with them. Because there's no way that this is going to work out year over year over year. And here's the why. So imagine a situation where you don't pay attention to the balance sheet and you just enter the profit and loss. Now, this is for all sole proprietors that those get filed on Schedule C. So it's part of your personal tax return. There's no balance sheet. They don't need the balance sheet to prepare the return, right? Also, with most corporations and partnerships that are like under a certain amount of assets or income, it's not required. There's a spot for it, but it's not required. They're doing themselves a disservice. They're going to cause themselves a problem if they are not filling out that balance sheet when it's not required. I have it set in our software to require it anyway. We have to file it anyway. And here's the reason. So you fill out the profit and loss, you pay no attention to the balance sheet. The prior year changes after you do that, right? So your balance sheet is changing. Your profit and loss is changing. Your retained earnings changes. So this causes two problems. The next year, when you're trying to file that tax return, the tax return software is going to be like, hey, this doesn't match. Your beginning retained earnings does not match the ending retained earnings from last year, and that's impossible. So you're either going to file that wrong, right? Like most tax software, it won't even allow you to file it. It's just like, nope, that's not a thing. You can't do that. So that's one of the problems. Then you have to go searching for that. And it is so, if you're a tax preparer and you're doing this during tax season, it's like going to take up such a huge amount of your time. You're doing yourself a disservice by not using it. But here's the other problem, and this is the one you care more about, which is if it changes from last year, let's say that the client ended up having, like it made a difference such that they have more income that should have been declared and wasn't, that's lost. And guess what? That's fraud because they have unreported income. Now, it doesn't mean you have to file an amended return for that year. There are tricks that we will learn in this Ask a CPA thing over time for taking that stuff and putting it in the current year as of January 1st, so that you still have like the correct ending balance from last year, and then you're making these changes from last year onto January 1st of this year, right? You can do that. It's not like 100% kosher by the IRS, but they would way rather you do that than skip declaring that income. Conversely, what happens if all of a sudden you add an asset from last year and you didn't depreciate it? Well, you've just missed a whole year of depreciation, or potentially missed everything because the taxpayer is never going to see that asset because they didn't look at your balance sheet. They're never even going to see that you have an asset that deserves to be depreciated. And additionally, what happens if a change you make goes the opposite, and instead of unreported income, now you have unreported deductions? Well, that your poor client's paying taxes that they don't have to pay, that they shouldn't have to pay, right? So there are like 1,000 reasons. And the reason I get so like mad about it is just irresponsible on the part of the taxpayer not to look at that balance sheet. But y'all know how important that balance sheet is. So in as much as you can start to collaborate with them, they're going to learn from you as well as you learning from them. That's what collaboration looks like, right? And over time, they might recognize, hey, this is really important stuff. We should do this. And I think that if they are unwilling to do that, this would be a really great example of somebody you want to put on your B list, or maybe your C list, or maybe your FU list, where over time, you're going to be getting really good referrals from the CPAs and EAs and other taxpayers that you want to be working with, right? And you'll have better and better and better clients and a better relationship with these folks. And you can get rid of those people. If they're not looking at the balance sheet, like you've got a problem. All right, so let's see. Teresa is asking, I have a client who's taken out several loans for purchasing equipment for his relatively new business, but the loans are under his father's name. I have both the asset and the associated loan liability booked in QBO. Technically, the asset and the debt obligation are both in the father's name, not the business's. I reached out to the client's tax accountant about this issue. Didn't hear back. Surprise. How should I handle this situation to ensure the financial statements accurately reflect the true net worth of the business? Should I just make notes on the financial statement, or is there another way to address this discrepancy? There's a great way to address this discrepancy, which is you can actually talk to the client and the client's father and the tax preparer, if you can ever get a hold of them and get them to respond. And you can call a meeting to say, hey, this is a problem, but a solution would be, can we, and this depends on the entity, you can't do this with all entities, but can we get the owner of the business or the business itself to sign a promissory note where they now owe the father the debt, right? So the loan on the books would be to the father, not to whomever the loan was actually with. And if they can get their name on the title of whatever that equipment is, even if their name is just one of the names on that title. But I will tell you, putting that asset on the books, even though it doesn't belong to them, is not the end of the world. That one is like not the worst thing that you would do. It's the debt that's the problem, right? Like you want to make sure that you have a promissory note with the father. It would be nice. It would be good to get that asset, to get your name on that asset as well as the father. But even to have like an informal agreement, it's got to be written. But even if it's an informal agreement saying, hey, technically I'm dad. Technically I own this, but I only did it for my son's business, right? And hey, I'm the dad, but I only took out this loan for the son's business because he didn't have the credit to be able to do this. Here's how we actually view this relationship. Like at the very least, get that documented and then change the loan on the books to be like to the father. But I mean, go to a lawyer. It doesn't even have to be a tax lawyer. This can be like a regular small business transactional lawyer. Make sure you have a few of them on your list because they're, man, lawyers, don't even get me started about lawyers, right? Like, the number of operating agreements I have reviewed that just have like everything wrong, and I'm not a lawyer, and I'm like, you took a template. All right, different topic. Anyway, have a few lawyers that you actually like and respect and go to one of them. This is a very simple transactional thing that they can take care of. And by the way, this stuff works with property that you're renting out. We have a client who originally his dad bought the space for his restaurant. Sarah is on here. I know you know who I'm talking about. Sarah, hey, that's my contractor, Sarah. She's amazing. She's one of the incredible members of our team. Hi, Sarah. So his dad bought, hi. His dad bought the space and had the loan. And so we structured it to be, you know, him paying back his dad and all of that. And it was really complicated because the old CPA had actually done it all wrong on the tax returns. We had to change a bunch of stuff. He had it set up as a real mess. It was more complex than this. But what we did was we went to a lawyer and we were like, what's the best way to restructure this? And they, not only did they like come up with everything correct with the title and the promissory note and all of that kind of stuff, but they set up a self-rental agreement, a lease, so that the dude who owned the restaurant could then pay this LLC that now owns the space rent. That's a complicated situation. Self-rentals, I'm putting that on my list. Self-rentals is totally something I have never brought up in any of these talks that I've given, but it's actually really, really, really important. Okay, so there's the answer to that. I hope that answers your question. All right, now I'm going to skip past other and, oh, no, actually there's one of them in other that I want to go to, which is, we got that one, we got that one. Okay, where is the best place to record guaranteed payments? This is actually a weird, you would think that there would be a straightforward answer to this. Y'all, there's like not a straightforward answer to anything in tax. It is the worst. It is just like this pit of despair. Let me tell you. That's why I love it so much though. So guaranteed payments, for those who don't know what those are, if you have a partnership, not S-Corp, not sole proprietorship, not anything, it's only a partnership, which could be a multi-member LLC, because those can be taxed in a bunch of different ways. If you have a partnership, and the partners are like 50-50 and they do the work 50-50 and they're just going to split the profits 50-50. You don't have to have guaranteed payments. You just split the profit. It gets taxed the same way as guaranteed payment income, so you don't have to worry about it. But if let's say you've got 50-50 and one person does like 90% of the work and one person only does 10% of the work, then you want that person who's doing 90% of the work to get 90% of some sort of pay. They want to be paid like for their services, like a W-2 employee would be paid for their services. It's not, you cannot be paid though as a W-2 employee for a partnership. That is against the rules. So the way that it works is that they get guaranteed payments. And this is something you have to outline in the operating agreement. You say, so-and-so is going to get whatever per hour or whatever per month or whatever per year or something like that as guaranteed pay. And this person's only going to, there's a little part for guaranteed pay. And then whatever's left over gets split proportionately by their ownership. So guaranteed payments is a way to kind of get that payment for services to partners off of the table before profits get split. So where to book it, there isn't an obvious place, because some folks are like, well, that's labor. If I as a partner weren't here, then I would have to hire somebody to do that. So I'm going to put it under cost of labor. But other folks are like, no. I don't want the amount I'm paying myself to affect my bottom line when I'm looking at operations, because I don't think of my labor in that way. In which case we put it in non-operating expenses, which are those two things underneath. It's other income and other expense. Some people think that means miscellaneous. I did for years. Some people think that means miscellaneous. It doesn't. It means non-operating. So something outside of the reason you have this business. And so you would put that under other expense, guaranteed payments to partners. And I have seen it where folks want those guaranteed payments. This is weird. So don't like do this, but I have seen it, and you will too, where some people will put guaranteed payments under the distributions for each partner on the balance sheet in the equity section. Okay, that's not what they are, but if they don't want to see it hit their bottom line at all on the P&L, you can put them over there and just communicate with the tax preparer, and they'll manually like move it on the tax return to guaranteed payments. It's weird because then you have like an off balance sheet adjustment. I mean, an off tax return, off books adjustment on the tax return. A solution that I have seen to that is that you can stick it over there throughout the course of the year and then move it right before you give it. You close the books and give it to the tax preparer so that at least throughout the course of the year, the client doesn't see that and doesn't freak out, because some clients just scroll to the bottom and look at that total number. Yeah, exactly. I see some people nodding. You know those clients. Okay, so since we're talking about distributions, I'm going to move to the owner draws and distributions section. Sarah asks, how does the money that gets tagged to owner's draw impact taxes for each of the LLC entities? I always thought the balance sheet was required for tax filing, to go back to the earlier conversation we were having, but recently had several accountants only request the P&L. Additionally, business owners ask me about owner's draw amounts and how that impacts their tax burden at year end. These are specifically folks who might be paying themselves through an owner's draw versus payroll. So this is a super complex thing because it changes depending on which entity you're dealing with. If you are a sole proprietor, you can only get paid through draws. We try to call them draws instead of distributions. They're kind of the same thing, but distributions, technically that term is reserved for partnerships and S-Corps. So they're draws, they come out of equity, and it's basically like saying, hey, all this profit belongs to me, but I'm not taking it out. I'm letting it stay in the company as equity, but it still belongs to me. That's how you get taxed on it. And then if you want to take that equity out, you take a draw on your equity. So that's how it works. It's only on the balance sheet, and it does not affect your taxes at all. It's not even reported on the Schedule C, because a sole proprietor gets taxed on the total profit in the business, regardless of whether they took it out or not. Now, we could have a whole conversation about whether it makes sense for them to take it out or not take it out, because there are lots of variables involved there. But that aside, they're getting taxed on all of it. So it does not matter if they take it out or not. It does matter, but it doesn't matter for taxes. For a partnership, it's the same thing. Guaranteed payments that we just talked about are going to be added together with the proportionate ownership share of the profits. And that's what you're going to be taxed on, regardless of whether you took any distributions. Okay, so those work really similarly to each other. And in both of those situations, the owner is getting charged self-employment tax on all of it. The draws, if it's sole proprietor, the guaranteed payments plus the proportionate, I'm sorry, not the draws. I just misspoke. The profit, whether or not you took it out as a draw, is getting taxed for self-employment as well. In a partnership, the guaranteed payments plus the proportionate ownership share of the profit is getting taxed for self-employment as well as income tax. So in all those situations, how much you take out, draws in a sole prop, distributions in a partnership, does not matter a bit for taxes. And that changes a little bit when you get to S-Corps because you can't have, to be paid for your services, you have to be on payroll. You have to get a W-2. So you're kind of paying payroll taxes on that, or self-employment taxes on that too, but in the form of payroll taxes. That's a whole topic we can talk about, payroll taxes for S-Corps, like how that works versus sole prop. Okay, see, we already have so many topics for this Ask a CPA thing. I'm so excited. So for S-Corps, you got to be paid for your services through W-2. And then all of the profits you're getting taxed on, whether you take it out or not, same rule as the others, whether you take distribution or not, you're getting taxed on all that profit. But that profit only gets taxed for income tax, doesn't get taxed for self-employment / payroll taxes, because self-employment is for Social Security and Medicare, right? So that's why some people are excited about the tax savings about an S-Corp, which by the way is totally overrated, especially since the Tax Cuts and Jobs Act. There's another thing, when to switch to S-Corp. Honestly, I could talk about this stuff all day long. I might, once you guys get off the call, I might just still keep talking about this because I love it so much. So, doesn't matter. How much you take out doesn't matter. In all three of those situations, what matters is how much the company made. That is what matters. All right, so let's stick with this topic of not owners, draws, and distributions, but payroll, because there are a lot of payroll and benefits issues. What payroll benefits are not considered taxable for S-Corps or partnerships, but should still be tracked by an owner or partner on the P&L for tax preparation? In parentheses, this is Heather, says medical, dental, vision, short-term disability, long-term disability, life, accidental death and dismemberment, which is like the most morbid thing anybody has called anything. No wonder they call it ADD, because like that's just terrible. Disability, all those things. This is wildly complicated. And so I'm going to give a shorter answer here because I think this whole topic like needs to be a webinar of its own. S-Corp benefits are just like the stupidest thing in tax code, except for like everything that has to do with a partnership. So second stupidest thing in tax code. So the way it works, and this is the part I want you to take away. So pay attention. I know it gets really complex, but this is the part you want to take away. An S-Corp owner of greater than 2%, I should say 2% or greater. So if you own 2% or more of an S-Corp, then you have to follow this wildly ridiculous process for medical insurance and a bunch of these other ones as well. You cannot be a member of a cafeteria plan. Even if your company has a cafeteria plan, you cannot be a member of it. You got to follow different rules. You can still get those benefits, but they're going to get taxed differently. And I should put this in the circle community. I should like list out very specifically which one, like how each one of these gets handled differently, I think that would be really helpful for folks. Mark, can you make a note of that? Sparkle, I would love it if you'd make a note of that so that I can do that. It's conflict. Here's the important part. Thank you, honey. Here's the important part. Medical insurance for an S-Corp owner is taxed in box 1 of the W-2, which means for income tax, but it is not included in box 3 or 5. That's Social Security and Medicare. Okay. And the reason for that is that they have to follow the rules that sole proprietors do for deducting the health insurance on their personal tax return as if you were self-employed. Like, how does that make any sense? Everywhere in the code, they're like, an S-Corp owner is not self-employed. They have to be paid through W-2. But for the medical insurance, we're going to make you deduct it on your personal tax return as if you were self-employed. It's so annoying, but it's not that hard to do. What we do on our chart of accounts for our S-Corp owners is we put medical insurance as a sub-account of owner compensation. That's how we do it. Yeah, we make that a sub-account. And that way, box 1 on the W-2 is going to tie out to your books, right? And it also means that if the tax preparer is preparing both the personal tax return and the business tax return, they'll see it and be like, oh yeah, don't forget to deduct that on the personal tax return. So at the end of the day, there's like no, it just cancels each other out, right? Like it gets taxed as box 1, but then you're subtracting it on the tax return as self-employed. And so you end up, and then it's not going in box 3 or 5. So you're not getting taxed as payroll for payroll, Social Security and Medicare, payroll taxes, self-employment taxes. Those are all the same thing, basically. So that's how it works. Each of the other ones is mostly treated the same way, but I put them in different sub-accounts because it's easier to track when we're doing benefits reconciliations. And I'm trying to remember which one, but one of these on here is treated differently, and I can't remember which one it is. So I'm going to circle back around to that one. Okay, so that's how we do it. And that's how I recommend you do it too. If owners, this is also Heather, by the way, follow up. If owners in an S-Corp are deducting their medical premium, can they also deduct medical expenses? No, they cannot. They can never detect. That's just like not a thing. That's never a thing. It will never be a thing. So you say, or should that be treated as distributions? That's the interesting part of this question. Because in general, I'd be like, no, just pay your medical expenses personally and don't mess that up. Don't like commingle funds with your business. Don't do that. However, every once in a while, I have a client that has like wildly high medical expenses because of some tragedy or difficult situation. And they want to track those medical expenses because they think they might get above the floor on the Schedule A, which is on your personal return for deducting medical expenses. In that situation, you could kind of do them a favor and have a sub-account of their distributions be for these medical expenses. We have done that. I don't recommend it. You don't want to commingle stuff, right? Like it pierces the corporate veil. It raises it. An IRS agent could question that. And so we don't want to do that if we don't have to. Every once in a while, I'll do it because, God, if somebody's like going through cancer treatment, okay, I'll put that in distributions for you. That sounds fine. We'll figure it out. Okay, more, nope, that's all for payroll and benefits issues. Okay. All right, we're going to move to profit and loss accounts. I'm going to circle back around to this one. Okay, so we're going to move to profit and loss accounts. Okay, Joanna asks, since the IRS is very specific on the deductions for gifts, What best practice would you advise bookkeepers to follow when recording business gifts for an everyone is happy type of outcome? Everyone meaning the client, the bookkeeper, and the tax pro. I want to insert a joke here saying, you think you're ever going to make everybody happy? Like, no, forget it. Somebody's always going to be unhappy. But actually, I don't think that's true. That's kind of why I wanted to start the Ask a CPA subscription, right? Like, I think that we can collaborate. I really do. And I think it's a win-win-win. It's a three-way win. The client, y'all, and the taxpayers. So I'm going to give a little bit of background here on the deduction for gifts. I know I call everything in the tax code like the stupidest thing in the tax code, but this is actually the stupidest thing in the tax code. They never tied the deduction for gifts, the limitation on the deduction for gifts, to inflation. So they decided, and this is not the IRS's fault, by the way. You will rarely hear me bash on the IRS, actually, because I think they do a really good job considering the horrible situation that they're in. Congress comes up with this stuff. And last time I checked, none of those people are doing their own tax return, okay? So, like, they don't have to deal with the stuff that we had. Thank you, Kim. I know. It's so annoying. It's so annoying. I think everybody in Congress should be required to follow whatever instructions they make, yeah, for taxes, and they have to do it on their own return. And then if they have questions about it, then they need to change the legislation before they send it to the IRS. Because the IRS is just, they take very few administrative, like, whatever that word is, administrative. They don't, there's no leeway on this, right? Like, they're interpreting the tax code. So what happened is Congress said there's a limit on giving gifts by a business, the deductibility, not the giving. You can give big gifts, but you can't deduct them. There's a limitation on $25 per person per year, like per recipient, per gift recipient per year. And they did this in like 01. Okay, that's before the tax. But like they did it in, I think, the 50s. And so it's still $25. Like, I can't even, I mean, honestly, a $25 gift is like almost impossible, right? So yeah, Diamond says $25 to buy a car in the 50s. And it's just so stupid. So a couple pieces of advice. One of them is you can train your clients. You really can. Not all of them, but most of them you can. And you can be like, look, it is not in your best interest to buy a gift that's more than $25. Find types of creative gifts where the person's getting more than $25 worth of value, but you're not spending more than $25. So that could be one of the examples is that we have a client that is a ceramics studio, right? And so like if they hold a special class for all of the people, you know, like a make it and take it class for all of the people they want to give a gift to, right? That's just sort of a party. That's a deductible event, right? You don't have to deduct that as a gift. So there's a way that somebody's getting more than $25 worth of value, but they're not, you know, you don't have to deal with that $25. So those are examples. There are also lots. I mean, I think it's Amazon Prime Day today. So, you know, there are lots of gifts out there that you can get for, yeah, Jessica, I know. Another one that I used for our 21st anniversary 2 years ago, we had a big party. We have a hyper local firm. And so like our whole neighborhood came out to celebrate. We had a big party with the Logan Square Chamber of Commerce that is also one of our clients, and a band that's a client of mine played and whatever. And I asked clients to give me either for free or a discount something that they have that's like extra. So I have a client that makes soap, and they have like the shavings that come off. They like make little bags of all of the like discards to make it so that their soaps they're cutting them like straight. And those little shims of soap go into a bag, and it's like a really fun gift to give away. And she was like, I'll sell these things to you for like a couple bucks a piece. But it's a really nice handmade soaps, right? Like was a really nice gift to give out. So also working with your clients that produce things or have services to offer is a win-win, because then everybody was like, ooh, I'm gonna go check out the soap place because these are great. So those are some ideas. As for the actual bookkeeping thing, this is actually a really hard one for us to deal with internally. And I'll admit, for years, I just said, look, I educate my clients, and I do, that there's a $25 per recipient limit per year. If they go over that limit, it's not my fault. I'm just deducting whatever this is on the tax return. I did it like that for a really long time. And then I hired a CPA to like help us out. You know, she's an employee of ours, Julie. She's amazing. And she was like, I don't think that you can realistically say with your with my high values and my high standards, I know that not everybody is following that rule. And do I want to defend them if the IRS audits? And I was like, yeah, no, I don't. So we changed our process, which was a real pain. But on our annual review, and some of our clients, we are doing this for like on a monthly or quarterly basis as well. I think that's one of our big things we're doing right now. We're trying to take things that we're doing on the annual review and sort of shift them. We're using Keeper, by the way, which I love. And I have an affiliate link. So if you are not already using Keeper, you should totally be using Keeper. And Mark, if you have that link, can you put it in the chat for people? That would be great. I love Keeper. They're amazing. And we have a thing where we're just like, that's one of the things that we're trying to move to monthly, to be like, hey, are any of these gifts over $25 per person? And so we ask the client to let us know how many, like, oh, there's $500 and it was gifts. How many recipients? And we put that in the memo. We just put how many recipients in the memo. Right? And then we can export that to Excel at the end of the year, and the tax preparer can take any of the gifts that are over $25, and we just do what's called a Schedule M adjustment, which means you don't have to change it on the books because it's a business expense. It's just not a deductible business expense. You know, penalties and settlements is a business expense. It's on the books. There's a chart account line for it, but they're not deductible. So those are called Schedule M's. We Schedule M it off the tax return, and it's adjusting entry. Book to tax adjusting entry on tax return. That's how we handle it. If anybody has better ideas, I want to hear them, because that's a little bit of a pain, but I think it's the right thing to do. Okay, if we are unsure if an expense is deductible, is it preferred we put it on the P&L and make it stand out, or as a sub-account of distributions? Definitely on the P&L so it stands out. Definitely. The things that get lost in distributions, honestly, I do not want to look through the distribution account unless it's a sub-account of distributions that is specific. So as we talked about before, sometimes we'll do that with health expenses. We always do that with tax payments because I want to see those tax payments coming through the business, even if they're personal. I know not everybody does that. And I know there's a little bit of risk in piercing the corporate veil there. I understand that. And I'm comfortable with that because it's way more useful for us to be able to see them there. Sub-accounts for vehicle expenses under distributions. We'll do that for people who are using the actual method instead of the standard mileage method so that they can track all of that. It goes through the business, but it's distributions. And then the percentage that we calculate that's personal use of company car, or the percentage that we calculate that's mileage reimbursement. That,
Hey, Nance.
Yeah.
There's a request for you to reread that question.
Sure. If we are unsure if an expense is deductible, is it preferred we put it on the P&L, profit and loss, and make it stand out, or as a sub-account of distributions? Definitely P&L. I don't want to see things in distributions that might be deductible. The only things that I want to see as a sub-account of distributions are things that are separately listed that we've already agreed on ahead of time with the tax preparer. We're going to track separately that are not deductible, or they're deductible in this weird way, like vehicle expense. I want to see it because it's personal estimated tax payments or extension payments, that kind of thing. We've already talked about it with the tax preparer. Those are going to go there. Anything you are unsure about, you know, your clients haven't asked my accountant. Why don't you have an ask my tax preparer, ask client's tax preparer account? These are like basically yearbooks, y'all. Like, call it whatever you want. put it in the other expense type. So it sits down there at the bottom and has a separate thing that's like ask the taxpayer, or WTF actually is a perfectly reasonable thing to have on there. Like really whatever you want to call it that, but have it under other expense, it pops out. And you're like, ooh, what's this? What's this weird thing? Please make it stand out. Don't hide anything in distributions, even if it's a sub account, unless you have talked to the tax preparer and said, this is how we're doing it, or this is how I would like to do it. Does that work for you as well? Some people are going to disagree with me. You're going to have some people who are like, nope, I want it over there. But probably those are the people who aren't looking at the balance sheets. So I don't know if you want to be listening to them. Client is an author. This is from, I'm sorry, that one was from Martha. I keep forgetting to say who said these. That one was from Martha. This next one is from Heather. Client is an author and having new headshots done for an upcoming book launch. Congratulations. That's very exciting. Can hair and makeup prep be treated as a business expense for the photo shoot? Yes. Yes, it can, which is one of the only situations where you will ever see that. The number of things that the IRS will not let you deduct, actually, I should say Congress, because remember, they're the ones who are making these rules, not the IRS. So they have these really restrictive rules. Anything that you wear that could be worn out on the street, whether or not you wear it out on the street, cannot be deductible as a business expense. So a suit, too bad. You can't do it unless it's a Superman suit, because you are Superman. If you are Superman, then you can deduct the cost of your suit because it cannot generally be worn on the street. And also you need it to fly. So it meets the definition of ordinary and necessary business expense. Ordinary and necessary, I did not make up those words. Those are in quotes. This is what the IRS says. And so every time you're like, is this deductible? Do you think this should be that? I don't know. Is it ordinary and necessary? Is it ordinary in that industry? Ordinary has everything to do with industry. Is it necessary? Did the client have to spend this in order to do their job? Superman needs to buy that suit. He can't fly, so it's necessary. And it is ordinary in the course of a superhero's life to spend that money. Anybody else, you're not deducting it. You're not deducting makeup. You're not deducting hair. You're not deducting. I actually had a flamenco teacher who wanted to get plastic surgery because she wasn't just a teacher, she was a performer. And she was like, in this industry, you have to look younger than you are. And she already did. She was in amazing shape and just looked great. But she was just like, I need to get plastic. And I was like, I am sorry. That is the only time the IRS is going to let plastic surgery fly is if it's for medical, like you were burned in fire and you need reconstructive surgery, right? Like that. And that's that's also a personal one. So your business can almost never deduct any of this stuff. But yes, you can if it's for a photo shoot. If it is for, let's say you're going to be in an advertisement, it's deductible then, right? So it's got to be ordinary and necessary. That's a yes. Joanna asks, what is the best way to track things like home office deductions, personal vehicle costs, and additional things that we don't want to mix in with the business's operating section of the P&L? Two ways to do this. We've talked about this a couple of times. You can either put it in other expense. In my opinion, in other expense, that would be things that you know are going to be deductible, probably, but they're either non-operating or you want to highlight them for some reason, like we were just talking about. Otherwise, they really should go in a sub-account of draws or a sub-account of distribution. So home office, vehicle, estimated taxes and extension payments, those kinds of things. Those are only going to be deductible by a percentage or not at all. And that percentage is going to be calculated through a completely ridiculous, frustrating personal use of company vehicle is like personal use of company car, PUCC. It's like actually a really stupid thing. You actually have to like look up the Blue Book value and do all these. I hate it. I make Julie do it. She doesn't mind. I hate it.
There's a related question.
Yeah.
Let me scroll up here. Do you advise clients to use personal accounts for all home office and personal vehicle expenses?
So that goes back to the piercing the corporate veil and whether the IRS would like see this as commingling expenses. I maintain, this is personal opinion. There's not one right way. Personal opinion. If the business in every other way is doing business as a business, right? If you look up on the IRS.gov, don't go to .com, .gov website, you can look up, I can't remember what the exact phrase is, but basically it's like running your business in a business-like manner. And so if you're running your business in a business-like manner, then you got to be keeping a separate set of books. You've got to have expertise in the area where your business is in. You have to either develop or hire expertise for the areas. They've got like this long list. If you in every other way are following those rules, and if for your LLC or your S-Corp, you are in or C-Corp, in every other way following the rules, the legal rules for your state about not piercing the corporate veil, then I think that you will likely be able to make the argument that these can be paid out of the business and you'll track them as different sub-accounts under distributions or draws, not dividends, because that's a C-Corp thing and those are actually double taxed. You don't want to do that. For a C-Corp, all of these rules change. I know we don't have many C-Corps, but maybe we should have a whole class on C-Corps because they're not common for small businesses, but they're out there. We have some. So I say put them in a sub-account of distributions. There are other folks who will say, no, I am not willing to do that. It both pierces the corporate veil and can cause problems with the IRS of commingling business and personal funds. So I put them in the regular section of the P&L or in the other expenses if I don't want them to be tracked as operating. So I hope that answers that question. Did that answer that question? I don't know. I don't even remember what the question was because it's not in front of me. So the best way to track those things, I think, is under, oh, I know. So the follow-up question, the related question was, like, do we think those should be run through the business or not? If you're going to track them as distributions or draws, as sub-accounts, yeah, they got to be run for the business. It's the only way it's going to pop up in your bank feed, right? And if you're not going to do it that way, if it's something that you would be tracking on the P&L otherwise, probably just have them pay it personally. One of the things that we actually do that I love, and y'all can do this, this is not a taxpayer thing that you have to do. You can have clients, I actually have a blog post. Look it up on, there's a version of it on MSN, but it's also on my Dancing Accountant blog that is how to have clients pull their own tax transcript, their account transcript, which shows all of their estimated tax payments and their extension payments and everything like that. So you could do it that way and then not run it through the business. We have them pull that anyway when we're preparing the tax return, just in case there's a mistake in the books. So I say that the best way to track things like home office deductions, personal vehicle costs, blah, 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 if it's something that you need that information on and only some portion of it is going to be deductible or it's not deductible at all, make those each independent sub-accounts of draws or distributions. If it's going to be deductible, then put on P&L. But there are going to be tax preparers who do not want those run through the business, and that's okay too. You just have to find some other way to track them, which is a real PITA. All right, Danielle asks, what are some standard chart of accounts categories, balance sheet and P&L, needed for an S-Corp versus standard ones for an LLC? I love this question. I asked this to help have my clients' numbers organized the best I can for the CPA. Now, we don't have enough time to walk through this from beginning to end, but that's one of the things I mentioned earlier for the Ask a CPA subscription that I would love to do a webinar on. We're like, okay, we're doing S-Corps today. We're looking at an S-Corp return. We're building an S-Corp chart of accounts. But the basic idea, and this is something you don't have to be in my new subscription to learn how to do this. You can teach yourself how to do this. Oh, that tea's not warm anymore. All right, going back to my pineapple coconut water. So the best way you can do this is to, on irs.gov, look up Schedule C. So that's for a sole proprietor. If the client, or if this is a client of yours already, just pull up a copy of the client's tax returns. Y'all should be requesting copies of the tax return every year, and ask for the copy that has all the work papers. Don't let them just give you the filing copy. Say, I want the copy with all the work papers. So look at your client's Schedule C, but if it's a new client or whatever, or you're being generic about this and trying, you know, that new thing in QuickBooks Online where you can have charts of accounts that you then like use for each new client. I like templates. I'm so excited about that. So if you're doing that, then just pull up a Schedule C for a sole proprietor, pull up a 1065 for a partnership, pull up an 1120-S for an S-Corp, an 1120 for a C-Corp, an 1120-C for a cooperative, a 990 for a nonprofit. I'm missing a few. There are a few out there. If you have questions, put it in the chat. I'll follow back up on that. Pull it up on your screen. And then look at every single slot that's in there. And if your client is likely to have an expense of some type in one of those categories, you want those on your chart of accounts. Now, there will be things like depletion for oil and gas. You do not need depletion for oil and gas on. I'm not saying make a chart of account for every single one of them, but make sure for any of them that are going to be used, you have one. So, and they're not the same. I know it's so stupid. Each of these entity types, like they didn't all get created at the same time in the tax code, right? Like in Congress. And so they didn't, it's not like they started with one and said, we're just going to use this template for every different type of entity. It's not how it worked. So they're all different. And so like some of them have office expense and some of them don't. If there's a slot for it and you're going to use it, then, or the client's going to use it, then put that in your standard COA. And I want to teach a whole class on this because I think it would be really, really fun.
There's a request for clarification there. Do you mean pull up the filing instructions for each?
No, the actual tax return. Great question. The actual tax, forget those filing instructions. There's no. Just pull up a copy of the blank tax return and look at the fields that are on there. Does that make sense? I hope that answers it. Oh God, not the filing instructions. The filing instructions. Yeah, PTSD. Okay, so Teresa asks, I have a client. Everybody here is going to be like, oh my God, I know this client. I have a client who continually commingles personal and business expenses. During a recent cleanup, he provided a credit card that was attached to QBO. However, the credit card is in his personal name and he runs both business and personal expenses through it constantly, including frequent restaurant and Walmart purchases. Additionally, he uses his business credit card for personal expenses like dining and shopping at the mall. I have that client too, except he tries to label them as business expenses and then we catch him. Now that he's getting fired, by the way. Now that I've finished the cleanup, I plan to detach the personal credit card from QBO and use a journal entry to classify these expenses as owner distributions. Despite my advice, he continues his practice. Given that I have documented this issue with emails and phone logs, do I have any further obligations? Should I just let him continue and keep reminding him that he's piercing the corporate veil, or is there another approach I should take? All right, there's a lot to unpack here. One of them is you are allowed to use a personal card as your business card. It does not have to be a business card. So that's one thing right there. You can go ahead and attach that. Now, I have heard that it can cause problems with the credit score of anybody else who is added on that credit card account, even as a read-only person like us. But each credit card handles that differently. Each credit card company handles that differently. I have decided it doesn't matter to me. And so we will get read-only anyway. I've never seen it make a difference, but I have heard that that can be a problem. So keep that in mind. Who has access to this account? But yeah, you can use a personal credit card. That part in and of itself is actually not a problem at all. The problem's the commingling. The problem is the commingling, partially because the IRS hates it, partially because think about how much extra cost is you're having to go through to log all of this stuff through the bank feed, to create a journal entry, however you're handling it. That is just ridiculous. And that would be what I would tell the client, be like, if you keep doing this, I am going to have to charge you an extra, make it a really big number per month, because A, it's a liability issue for me. I want to make sure that I'm following the rules. And even if you're not willing to follow the rules, I want to follow the rules. So if this were to become a problem with my E&O insurance, we don't think it would be, but like, if this were to be a problem with my E&O insurance, and it could be, then I need to protect myself from that. Also, it is taking me a ridiculous long time and at no value add to you. Why would you do this? This doesn't make any sense. I recently talked to a client who is starting an LLC for a rental property that she's had for a while, but she's just now doing that LLC for it. And we're just now putting her, now that we have QuickBooks Ledger, which is actually like affordable, we're putting her on QuickBooks Ledger and we're getting her off of Excel. And I was like, I am only going to do this for you if you have a separate card, like a credit card. If your credit card is only used for the business, I will not do it if you're commingling, because that is not worth my time and it's of no value to you. So I would focus on the value to the client. I would make sure you're charging them way extra for this. And if you need any tips on pricing, talk to Deb Kilsheimer. She's like the expert in this space on that. She will. And even if you don't need somebody to tell you how to do it, she'll just cheerlead you. And she'll be like, you can do this. So like, talk to her.
There's a Hope
Yeah.
asks, are you saying that the read-only QBO could affect credit rating?
Not the QBO, the credit card. So if you are given access, again, I have never noticed this with my own credit report. Okay. I have heard this. I did research on it because somebody submitted that as a question for this. I did research on it. I could not come up with a definite because each credit card company does it differently. And each credit reporting company reads that differently, right? They don't all see read-only access as the same thing. So it's like, I don't know. But supposedly for some credit cards with some credit reporting companies, if you have read-only access, that could be considered an authorized user and could affect your credit report. I don't know why anybody would take read-only access as an authorized user. I mean, most of these companies have a difference between authorized user but I know that some of these credit cards, especially the ones that like go through a credit union that doesn't have good technology, the only way you can get on the credit card and be able to see the statement is to be an authorized user. And that does happen. So I wouldn't do that. I would never, ever. That's too much liability. And that does affect your credit report for sure. But I don't really know. Read only for a credit card. And supposedly it's only for the personal ones. It's not for the business ones. This is not my area of expertise. So like only take that all with a grain of salt. The important part here is make them use a card, whether it's personal or business, make them use a card for business and say, do not run your personal stuff through this business. Do not do this. It pierces the corporate veil. There's liability to you. There's liability to the company. There's like, it's wrong for a bunch of different reasons. And it costs you extra. Why would you want to pay me extra for no value whatsoever? That is what I would say to that. Just make them do it. If they keep doing it, I mean, just charge them extra. And, maybe, I don't know. I can't imagine that coming back and really stinging you because you've documented the fact that you told them a million times to stop doing this. But like yesterday, I went to Whole Foods and it was the first time that I ever paid with my like Amazon thing on my phone. And the last thing I have bought, which was a prop for a talk that I'm giving at bridging the gap was a business expense. And I didn't see that. So like my Whole Foods purchase went through as a business expense, right? It happens sometimes. I get that. Move it to distributions or put it into the loan account, the due to from owner or due to from shareholder. That's a really nice way to do it. You don't have to document that unless it gets over, I think it's $20,000. If it hits over $20,000 anytime in the year, then you do have to have a promissory note for it. But if it doesn't, if you're just like a few $100s in either direction constantly, that's actually a really great way to handle it. Or just like have this person, I was about to say dude, because I'm presuming it's a dude. It sounds like a dude thing to do, but women do it too. Have this person reimburse the company every month. That'll get them to stop really fast, right? When they see that I have to write myself a check or like send myself a Zelle for how many dollars? Woo! I do have one client though who put his golfing through the company because he doesn't want his wife to see how much he spends on golf. Yeah. He's a good guy, but he really loves golf. And I was like, hey, we're gonna run it through distributions. It is what it is. He has enough profit to warrant running it through distributions, but running it through distributions in an S-Corp, if they have really low W-2, is a serious problem for reasonable compensation, which is our next question. Reasonable compensation. Is this something your team does each year, or how does this process work? Currently, I'm only making my clients do it every 2 years. I think I need to change that. But I'm only making them do it every 2 years, but they have to do it every 2 years. And I use RC reports, which I don't have an affiliate link for yet because they're still working on that program. But if you sign up for RC reports and you tell them that I sent you, I don't know, maybe they'll send me flowers or something. I don't know what will happen, but I would appreciate it if you would reference me because that would be great because I really love them. I use RC reports. It costs like you pay a certain amount every year, or you can do one-offs for each client. And actually the next question is, how does a bookkeeper consult on this without paying for the annual subscription or for a single report for RC reports? So number one, they run specials really often and I find out about those. So let me know. And when they're running a really good special, I can post that in Circle in our subscription. And so that you can get like half off with this code or whatever. So like they do run really great specials. Hope, I think you signed up for them at Scaling New Heights. Were they running a good special for Scaling New Heights attendees?
It was like 500 off.
Yeah. So
Mhm.
yeah. So I think that ends up making it like $400 or $500 a year for a subscription, something like that. I don't remember exactly.
Maybe a little higher.
Maybe it's higher. Okay, I don't remember.
Yeah.
I've been using them since I don't even remember 2013 or
Okay.
something. Like a really long time. I love them so
Mhm.
much. They are a huge help. And you know what? I'm not even charging a premium for it. I know you can charge premium and I encourage you guys to charge premium. Don't be me. But I'm doing it because I'm trying to protect my clients and I'm trying to protect me. And so it's an interview that you do where and actually I have a lot of tips and tricks on this, and this is one of the first webinars that I want to teach. I want to pull up reasonable or RC reports and screen share and show you exactly what I'm doing because I don't do it exactly the way they suggest doing it. I do not let the client fill out that interview. Oh my God. When clients fill out that interview, they're like, I am an expert in all of these areas. And I am also the CEO. And I am also, and it's just like, oh, your reasonable compensation should be $1.5 million a year. And you've got a $200,000 a year company, right? Like, don't let the client fill it out. I send them a questionnaire PDF and I have them fill out some stuff on the PDF and send it back to me. I look at that. I go, right, on a lot of it. And then I have a meeting with the client where I fill it out on my screen while I am talking to them. I'm not even sharing my screen with them. I'm just talking with them on Zoom and I'm filling it out. And it's this many hats approach is the idea. The IRS doesn't have a definition of reasonable compensation. They basically say whatever you would have to hire somebody to do that job, that's what reasonable compensation is. They ain't nobody out there going to do my job. I'll tell you, there's like, you could not pay somebody enough to do my job. So I don't know what my reasonable, I have to do this for myself. Mark and I actually, I do our reasonable compensation interview for us. So you go through and it's just like, okay, you're a janitor part of the time. You're a janitor part of the time. You're your own bookkeeper part of the time. You're the salesperson part of the time. You're a chef part of the time. And we look at the percentage of your time that you're doing each of those things. And then we're looking at your expertise. How good are you? They suck at bookkeeping. I tell every single one of them, if you give yourself anything higher than average or below average on this, you are lying, I promise you, because you're comparing yourself to a professional bookkeeper. If you are running a restaurant, I promise you, you're not professional. Well, actually, that's not true. Some people are professional bookkeepers and then they become a chef. Whatever. Most people, that's how it works. So we do it every 2 years. We require it. If they have a major change in the services they are providing to their company, we ask them like to do another one with us because it's going to change. And you're not just making sure they're getting paid enough. You're actually making sure that they aren't getting paid too much, because we had a client that went from basically being an electrician and doing the stuff all himself all the time to hiring out all the work to repeating customer. And then also, so we hired all the work to contractors and all the work was from repeating customers. And he ended up spending like 10 hours a week doing almost nothing. And so like we changed his reasonable compensation accordingly. I mean, he wasn't working in the business. So why? And our tax specialist, Julie, she was like, oh, he's making this many dollars in profits and only this much in reasonable compensation. I think you should increase that. And I was like, no, I'm not going to, because the IRS can audit him and I will show them the report that shows exactly how we got to these numbers. So keep that all in mind. How
Hope-
can you
Hope
do it
has-
without? Yeah.
Hope has a follow-up question.
Sure.
What if the reasonable compensation number you come up with is something that the business can't afford?
That is a great question. That's a wonderful question. So the rule is not that you have to pay that amount of reasonable compensation. And by the way, all the rules come from court cases. And I want to teach a class on reasonable compensation so badly because I think those court cases are so interesting. So in those various court cases, there was only one example of somebody having to pay it out even though they didn't have the profit to support it. And he represented himself in court and was an idiot. So I throw that one out. I don't think it counts. Everything else shows that all it means is that you can't pay yourself distributions until you reach reasonable compensation. So let's say reasonable compensation says you have to pay yourself $27,000. You only have $10,000 profit. We'll pay yourself $10,000 and no distributions. And then the next year you have $30,000 of profit. You pay yourself $27,000 of W-2 and $3,000 of distributions, or maybe leave $3,000 of distribution in the company because that's not enough working capital to keep the company running. But then the next year you have $100,000 profit. You pay yourself $27,000 and all of the rest of it can be distributions, right? So you just can't pay out distributions until you hit the reasonable compensation number. Also, if the RC report comes back and you think that that number doesn't gut check and you want to gut check it yourself and you want your client to gut check it, is this what a role like this in this industry would be paid? If it doesn't line up, you did something wrong in the interview. Go back and tweak it. You have 30 days before that report locks. So if you don't want to pay that money and you don't want to have to learn how to do reasonable compensation, don't. Call me. I got you. I will charge your client, or I will charge you. I will charge you and you can white label it to the client, or you can connect me with your client and you'll get a finder's fee or whatever, right? Like this is my wheelhouse. I know reasonable compensation, right? Call me. If you don't want to call me, call somebody else. Hope just bought it. She's going to learn how to do it. Yeah. Hope, I'm going to teach you how to do it before you start doing that. Okay. For other people. All right. Okay, cool. So there are lots of people out there who know how to do this. And by the way, this is not a tax preparer thing. Taxpayers don't know how to do reasonable compensation either. Right. And this is where you can protect your clients You don't have to do the reasonable compensation. You can just look and you'll be like, okay, $90,000 of distributions and there's no W-2, that's a problem, right? Like you can bring up that problem and then say, I have somebody you should talk to. Or $90,000 distributions and $10,000. Maybe it's correct, but probably not. Have somebody look at it, stress test those numbers. We've only got 5 minutes left and we still have a lot of questions, although we got through most of them. Let me see if I can grab, do you have a process or template that you share with your tax team that you update throughout the year and hand over to them at year end? We do now. It's one of my favorite things in the world. Sarah helped us make it. I love it. That's something I definitely want to go over in the Ask a CPA subscription. For those of you who came in late, we're doing a really cool thing and it's 30% off for the first year for the first 50 participants. We're not going to let anybody else in except for these 50 people for right now because we want those people who are getting 30% off, which means instead of $47, it'll be $33 a month for the first year. We want y'all to help us make this community the best thing it can possibly be. And we really appreciate your input and your help in being a founding member. So you're going to get 30% off for the first year. Hopefully Mark's been spamming the chat with information on how to join that. And I'm super, super, super excited about it. And we'll get lots of this, but also webinars. And sharing the process and template that we're using internally will eventually be one of the webinars that we do. Let's see. Okay. What sets a good bookkeeper that you want to work with apart from a mediocre/poor bookkeeper that you dread working with, especially as it relates to year-end tax filing? Proofing the balance sheet. If somebody proofs the balance sheet, I love them. But most importantly, it's like a mindset. I don't want to work with anybody who thinks they're just a bookkeeper. I actually had a situation happen. We were hiring a junior bookkeeper recently. I got 120 resumes, not counting all of the people who were offering to offshore. I had 120 viable resumes that I went through. And I narrowed it down to like 15, did follow-up emails, narrowed it down to 2 that did projects for us, like a one-off sample project. And one of them was like, yeah, I'm badass. She literally calls herself the badass bookkeeper, Allie. She's great. And she just like ran with it once she got guidance on, but she asked questions like, I don't know how to do this part or that part or the other part. And so we walked her through that. And it was great. The other one was like, I don't understand why you're hiring for a bookkeeper job. And I'm just a bookkeeper. I'm not a tax preparer. Why are you asking me to do all this stuff? I've been bookkeeping for years and I have never been asked to do any of these things. And she ghosted us. I'm not kidding. It's a mentality. You're not just a bookkeeper. There's no such thing as just a bookkeeper. You are an amazing human being who is caring for your clients by owning these books and making them the best they can be and getting rid of clients who won't follow the rules and getting rid of tax preparers who won't follow the rules. You are incredible and wonderful and amazing and capable. You can do reasonable compensation. You can proof the balance sheet. You can tell your clients you're not doing it right. It needs to be done this way, right? Like you're in charge. So what sets a good bookkeeper apart is a mindset that you are capable and important. That is what makes a good bookkeeper, in my opinion. Let's see. Best method to post tax refunds or tax payments from a prior period in a current year is a really complicated question that I think we're probably going to do a whole webinar on, but it depends on 2 things. Is the client cash versus accrual basis? That's a huge, huge one right there. If they're cash basis, you don't need to do anything. Just put it in the memo. But oh my God, please put it in the memo. That was a huge improvement internally for us. Is this payment for last year? Is this payment an extension payment for last year? Is this payment an estimated tax payment for this year? Is this payment a balance due payment for this? Like that is really important. And it also depends on entity type, because is that going to end up being a payment that goes on the P&L because it's actually a corporate or pass-through entity payment? Or is it going to be on you know, in a sub account of distributions. So how to post it depends on those things. We are at time. I got through all of them except for like 3, which is pretty good. And we actually covered most of the other ones accidentally because I'm a talker. Y'all, this was beautiful. Thank you so much for being here. I really appreciate it. It is really nice to see so many friends in this. I got this on gallery so that I could, like, for the people who have your cameras on, I can see you. Thank you for being here. I hope this was helpful. I hope it was so helpful that you want to join my Ask a CPA subscription, but I will not take it personally if you do not want to. I do offer consultations to non-members. They're just more expensive and you have to book a full 2 hours. So if the subscription isn't right to you, but you have more questions, let's do this. That's an option too. I'm glad that you're interested. I'm glad that you want to make your clients' books better. I'm glad that you want to communicate with tax preparers better. And I know that the ones who are going to be inclined to respect your work are going to love the heck out of you, and you're going to establish really good relationships with them. And you're not going to need the other ones. Like I said in the Scaling New Heights Tax-Ready Bookkeeper, you know, find a new dance partner. So from Nancy McClelland, the dancing accountant, and Markle Sparkle, our very dedicated, yes, chat person, we appreciate it. Thank you so much for being here. And I'll make sure that this recording gets out to all of you. Have a wonderful week. Bye, bye, beautiful people. Oh my God, bye. Oh my gosh, it's so good to see you all. Take care. Hi, Monica. Hi, Corey, Karen. Oh gosh. Take care. Bye-bye.